Hey guys, welcome back to Dividend Obsession. My name is Troy. In today's video, I kind of wanted to just build off of my last video, which will be linked somewhere here on the screen, where I talked about choosing your time frame, risk tolerance, and dividend stock criteria to help you get started in your own journey and share with you all my own personal journey. Disclaimer, I am not a financial planner, so please note that any info in this video is for entertainment purposes only. Now let's get to the content. All right, so in my last video, I mentioned that getting started is very scary. I was in the same shoes you guys are. I didn't know what I was doing, and I was more afraid to lose money than I was excited about the possibility of making money. Looking back at it now, I'm glad I finally got started, and I'm a little upset with myself that I didn't get started sooner. Speaking of starting sooner, I'm working on researching more on investing for kids and the different paths you can take for one of my next videos, so be on the lookout for that. All right, so getting started on this one, I wanted to follow the same steps that I provided to you guys in the last video about how I got started that will maybe, hopefully inspire somebody to just get started. So step one, again, we need to make decisions on our time frame. So when I first started back in 2020, I did not really have a time frame, but I knew once I saw some very small dividend checks coming in that I wanted to see if I could build that up and see where it goes. It was probably late 2020 or early 2021 that I decided that my goal was to retire at 50, and I started working towards that. I would say my current time frame, so answering the question of time frame, my current time frame is about 23 years, as I am 27, and that would get me to the ripe young age of 50 years old. So time frame, step one, or part one of step one is time frame. The next thing I outlined was your risk tolerance. So as I mentioned in an earlier video in the beginning, I was a lot more afraid to lose money than I was to make money. Not afraid to make money, afraid at the possibility of losing money than I was excited to make money. I'm still like this now, but I do realize there are such thing as calculated risk, and that you also have to take a little bit of risk to make money that could change your life. So I would consider my risk tolerance at this point in my life as a moderate per the chart that you'll see right here on your screen. So the next thing, part three of step one is figuring out your criteria that you'd like to narrow down your stocks by. So this is another one that I didn't really have narrowed down when I first started investing, but I have done better with as time has passed. If you are able to narrow down your criteria now, you'll save yourself a lot of headaches in the future. So my criteria when I first started was strictly looking at Robinhood. I'd go to the search tab, see which stocks were up the most in the day, and that's what I did. That slowly changed into looking for just stocks that paid dividends. If it didn't have a dividend payment, I wasn't looking at it. And then I started to focus my attention on, I started to realize there was different things such as just dividend stocks and then quality dividend stocks. So I started focusing on those types of lists. Main criteria I use at this point in my investing journey are as follows. So I like to look for dividend companies that have at least 5 years of consecutive dividend raises. That's just a good start. There's a couple companies that you'll see in future videos that I'm invested in that don't meet the dividend aristocrat or dividend king list, but you'll see, we could all argue that they are some of the best companies in the world. So I don't want to, no spoiler alerts here. So again, I like 5 years at least of dividend growth. I like a 10% dividend growth rate over the last 3 and 5 years. And then the next thing I really use is I like my stocks to beat the S&P 500 over the time frame that I search by. A really, really, really good resource for this is dividendchannel.com. I will leave a link in the description for this. It allows you to type in a ticker, and then you can compare it to different indexes, S&P 500, NASDAQ, whatever. And then it'll let you compare them one over a course of time. A lot of times I don't know what the default is. Maybe it's like 20 years, 15 years. But what it also does is it will show you what it's like when you reinvested dividends versus not reinvested dividends. And it does it for both. So the S&P 500 does pay a dividend. So if you have, I don't know, say Apple, and you say, hey, I bought $10,000 worth of Apple in 1999, and I bought $10,000 worth of S&P 500. It'll show you two charts. It'll show you one chart with what they both would have done if you reinvested dividends for both, and it'll show you another chart that shows you if you just had $10,000 worth without reinvesting dividends for both also. Again, for my sake and for hopefully any audience that I gain, we know to reinvest those dividends. It doesn't necessarily have to be in the same company, but you don't want to take that money out yet. I mean, that's not where we're at in our journey. We want to reinvest it and get that snowball rolling, as we talked about before. So, and the reason I want to beat the S&P 500 as my third criteria, because if you're at the end of the day, like if you're not beating the market, the S&P 500, you might as well just invest in the S&P 500. So if you're going to take the risk to invest in individual companies, and filter your criteria and do all your homework, you need to beat the S&P 500, because if not, it's pointless. You're doing all that work for no reason. You just put your money in the S&P 500. Hopefully, it grows 8 to 10% per year. Hands-off approach. So. And one thing to note with that dividendchannel.com is it does show past performance. Nobody knows what the future holds, and everybody knows that past performance isn't indicative of future success, but it's a good starting point to look at. So that's all step one. So you want to figure out your time frame, and mine is 23 years, give or take. Risk tolerance, mine is a moderate risk tolerance, as you saw per that chart. And criteria, at least 5 years of dividend growth, 10% growth rate over 3 and 5 years. That maybe there's a 10 year. I like to look at that one too. Maybe that's 10% as well, or at least 10%. And then beating the S&P 500. Those are my three main criteria. I dig a little bit deeper once I actually narrow down my stocks. But for now, that's what I go with. So step two, figuring out where to start. So as I hinted in both my last video and in step one of this video, once I figured out what I wanted to start looking for, I resorted to the list of dividend blue chip stocks, dividend aristocrats, and dividend kings. I personally combined all these lists into one mega list, but that'll probably be way too much for most of you guys. It's very overwhelming. I still, like I said in the last video, I recommend picking one of these lists and then just doing your research and your criteria on that list. It was very long to look through that whole list. So, figuring out where to start, I went with those three lists, and that's what I based my criteria on. So step 3 of my process is to apply the criteria. So step 3 is really about taking the info you outlined in step 1 and combining it with the list that you put together in step 2. For me, I was able to filter the list of blue chip stocks, aristocrats, and kings down from 353 stocks at the time to 66 stocks. And that's just by applying that 5-year consistent dividends, the 10-year 10% 3 to 5 year dividend growth rate, and the beating the S&P 500. If you have a long time horizon, let's say more than 15 years, maybe you don't look into the yield of companies that much and focus more on the growth rate of the dividend, the potential growth rate of the company, and its payout ratio, since you hope to hold this company for a long time. And you want to make sure that they can not only support the dividend and the growth of the dividend, but they're also putting money back into the company to help that grow as well. So you can, like I said, you can grow your wealth by dividends, you can grow it by capital appreciation. Best case scenario, you're growing it by both. So another note is there are several brokerages that now offer what we call fractional shares. So the purchase price of a stock should not sway you one way or another from buying into a company that meets all your criteria. So again, there's a thing is like overpaying for stocks and very cheaply priced stocks that are still good companies as the market goes up and down. But if it's like, hey, I have 2 companies and I want to get both, but this one costs more money than this one, I don't want to invest in this one because it costs more, fractional shares are wonderful. If you have $100 and you have, let's say we have 2 companies, you have a $100 company and a $200 company. They're both great. They met all your criteria. You did your due diligence. You have $100 to invest in each. You don't have to wait until you get $200 now to invest in the $200 company. You can spend that $100 and get half a share, and then everything's just half. So when you get a dividend, say they pay $2 in dividends, you would get $1 in dividends instead. And with the $100 company, obviously you have $100 to invest in that company. You put $100 in, you get one whole share. So if they give a $2 dividend as well, you would get a $2 dividend. So fractional shares are great. I will put it on screen right here. All the places that offer fractional shares in some way, shape, or form. So as a beginner, it is far more important to get into the market and buy companies that you choose on a set schedule. So buy in frequently than it is to waiting for a stock to drop for a good price. That's why fractional shares are great. And always remember, time in the market beats timing the market. Keep that in mind anytime you're thinking about waiting. So we're going to get into step 4. Step 4 is to do your research. So now that you have narrowed down your list based on the things that you want in your portfolio, the next step is to do your research. Ideally, you will have a relatively small list of companies to really look into and make sure things are on the up and up. Again, like I said, I went from 353 to 66. I combined 3 different lists of stocks. Like I said, I personally recommend choosing, just say, hey, let's pick the Dividend Kings, pick some things I want these companies to have, whether it's name recognition, a certain payout ratio, percent dividend growth, whatever it is. Obviously, for those, you really don't want to search for years of consecutive dividend growth because they're all on that list for a reason, because they're all 50 years or more. That's what the Kings are. So you want to look at, like I said, how's the payout ratio? Are they making more money than they recently did in the past? How's the hold on their competition? Do they dominate the market, or is there a lot of competition that in the future might, make them not as dominant, therefore not make as much money, therefore not, their stock doesn't do as well, therefore you don't do as well. So those are just some basic things to look at. So doing this step, it is crucial to feeling good about your investments. This is something that I just recently started doing, where I log my thoughts in an Excel document to remind myself why I made the choice of that stock. What this does is it helps you when the stock eventually, because all stocks do this, all stocks don't just go up and to the right the whole time. So what this does is when a stock does go down, you can look back at this log and say, you don't panic, right? So if a stock goes down, you're like, oh no, did I make the wrong decision? If you can go back to this little journal or this little tab in an Excel and say, hey, I bought this stock because X, Y, and Z. If you look at the stock and it went down 20% and you still see X, Y, and Z, it's a discount. Buy the dip. That's really what it is. As long as the fundamentals of the company didn't change or whatever, then it's a discount. It's a buying opportunity. Now, if you look at the stock and, hey, something that I valued in the company that made me purchase this stock has changed, then you can reevaluate your decisions at that point. So so that's basically step 4, do your research. And I added that little thing in there. Like I said, I just started this for myself, is kind of justifying to yourself, remind your future self why you made the decision you did. And it makes it really easy when there is a discount or a dip in the stock to decide what needs to happen next. All right, so step 5, my last step in my process, is to pull the trigger. So as I mentioned in the last video, this is arguably the most important step in the process. If you are anything like me, I have no problems doing the research on stocks. I actually weirdly find it fun. But I do get what I like to call informational paralysis, where I fail to act on the research out of fear that there is more research to be done. So this is, again, speaking from experience, there will always, always, always be more to know on anything you look up. You're never going to know 100% of everything. It's just, you don't have enough room in your noodle for that. So this is why writing down your metrics you saw to lead you to that decision it's a good idea. So you can look back at it and say, okay, I made this decision based on these metrics. And then, in 5 years, if you're like, oh, okay, I lost 50% on this stock, maybe those metrics aren't good, or maybe they weren't good for that stock, or maybe they weren't good for that stock in that sector. So there's a lot of different things, but at least when you write everything down, you can go back, and as you learn more, after you pulled the trigger, you can say, oh, okay, maybe this isn't something that I need to worry about. So, and I will leave you guys all with this. For step 5, I heard this in a song once. I often reflect back on this, not just in investing, but life in general. It says, I never lose because I either win or learn a lesson. That's a really good thought. So again, you just doing the action. You're either going to win, you're going to get it right, and you're going to, look like a genius, feel like a genius, or you might be wrong, but you didn't lose. You did learn something valuable out of that endeavor. So again, pull the trigger, step 5. That's really all I got. So that's going to wrap it up for today's video. Please be sure to do me a favor and hit that like button if you enjoyed the video today. Sub if you're new to the channel. I can see right here that a lot of people that watch this video are not subbed. It would be really, really great if you guys could sub for me. And then comment down below when you started investing and when you hope to retire. I'm curious when everybody, if everybody plans to work till 65 or if people have goals and dreams to get out of the workforce early. So also, I have a bunch of videos planned, but if you guys do have any suggestions for videos that you would like me to cover, my opinion on, let me know down in the comments below. I'd be curious to see that, and maybe I'll get to cover that one day. So with that being said, until next time, see you.